Dr. Babasaheb Ambedkar Open University.
Welcome once again. This is Professor Manoj Shah. I am a professor and director, School of Commerce and Management, Dr. Babasaheb Ambedkar Open University. Welcome again in the course of Fundamentals of Financial Accounting. As we discussed in the first unit, first module, that is Introduction of Accounting. So in Introduction of Accounting, what is accounting, history of accounting, need for accounting, importance of accounting, characteristics of accounting, and accounting is an art and science, so that we were already discussed. Now today we are actually discussing accounting terminology. See, accounting is very important. Why the accounting is actually required, that we already discussed. Now, for accounting, which kind of terminology has been used in accounts, that also it's equally important. So now in this unit, we are trying to understand the accounting terminologies meaning and what kind of usage of accounting terminologies in the writing of accounts. So now let's begin with the accounting terminology. So here, the accounting terminology all about that, how to write the accounts, what is the business transactions, what are the assets, liabilities, capital, drawings. So these are the terms, right? These terms has a certain meaning, and that meaning has to be actually understood before you writing accounts. Why? Because of these terms has actually a specified specifications of the writing and accounts in the books. So if you are understanding this terminology specifically or precisely, then it would be very easy to write an accounts in a systematic way. So that's why this terminology is focused in the unit module number 2. Here, the first terminology is business transaction. What is all about business transactions? How you can understand this business transaction? The business transaction is all about which is actually evaluated in economic value. So those transactions which has an economic value, which can be converted into a monetary terms, and any kind of transactions has a monetary values or in a monetary amount, that's called a business transactions. So in that sense, the transactions which have a monetary values consider as a business transactions. It can be a cash transactions or a credit transactions. The cash transactions, it can be considered very easily. Those transactions which are easily cash given or maybe taken from the customers or to the customers, that is considered as a cash transactions. Example, suppose rupees 4,000 goods purchased from XYZ. So if it is 4,000 rupees goods purchased from the XYZ, so it's considered that we purchase the goods and paid a cash. So ultimately it's considered a cash transaction. Cash is directly involved in this particular transaction. So that's considered as a cash transaction. It is a business transaction, but in business transaction, it's a cash transaction. In case of the credit transaction, suppose the same transactions, rupees 4,000 goods purchased from XYZ on credit. So in that sense, we purchase the goods from XYZ, but it is purchased on credit. So that means the cash was not paid immediately. Here, it might be the cash will involve later on, or maybe it will be paid in the some other time. So in that sense, the transactions is a business transaction, but it's a credit transaction. So business transactions have a possibilities of cash and credit both, but if it has to be a monetary values or if it can be converted into a monetary value, it's considered as a business transaction. Moving to the next. Now, events and transactions. See, events and transactions, I want to tell you very simple. Any kind of a business transactions can be considered as an event. Any kind of business transactions can be events. But any events cannot be a business transactions. Very simple way. I'll tell you examples why it is. Suppose the purchase goods of rupees 10,000, it is actually showing in your example. The purchase goods of rupees 10,000 in cash, it can be considered as an event also and transactions. Why? Because of any kind of a business transactions, I'll consider as an event. Here, the any transactions is converted because of you purchase the goods of rupees 10,000. So here, the it is a monetary transaction. So that's why it's a business transaction. The second thing is this purchase goods, so the cash is all involved. Here it is a cash is involved. In case of a credit also, it can be considered as an event. And simultaneously, it is a transaction also because of the cash is actually given and take. So then the another way is the goods also comes in and goes out. So that's the way the transactions and events both are takes place in particular event. But in case of, suppose if any person is actually planning to start a business, or maybe if he has already business and he wants to expand his business, in both the transactions the events is there because of the transaction is already maybe coming later on, but the events is already done. Which events? The person is already running a business, or maybe the person is willing to start a business, so that means it's a thoughts in events. The second is he might expand his business, so that is also considered as an event. But the business transaction is not comes into the picture. Why? Because of it is just a thought, it's an event. But here the business values and monetary transactions is not takes place here. That's why the events is there, but the transactions is not takes place. So this is the difference between events and transactions. As I mentioned, any kind of a business transactions can be an event, or it is an event, but any events cannot be a transaction. Great. Moving to the next. Now that's capital and drawings. What is capital and what is drawings? Very simple way. The owner or a person who runs the business or who are willing to start a business brought money, cash, or any assets in the business to start a business or to run a business, it is considered as a capital. So the value, total value of cash, assets, or goods, it's considered as a capital. So the person who brought in the business cash, goods, or an assets, the worth of total amount, it's considered as a capital. Drawings. The person who actually withdraw any cash or a goods or any assets for the personal use for outside the business, considered as a drawings. So the drawings is not an expense. That is what I want to clarify here. The drawings is just a amount of capital reduction. It's not a expense. The person, the owner of a business, can bring the money in the business and can withdraw the money or any kind of assets or stock from the business. So these are the terminology when the person who brought the money in the business consider a capital, not only cash, or it is might be cash along with the assets or maybe other stock. The same way, if he withdraw from the business, is considered a drawings. Moving to the next. Now, liabilities. See, the liabilities have a different understanding. The liabilities means that any obligations or any amount which is to be paid to the third party by the business or by the owner, it's considered a liability. In this case, the liabilities have a many concerns. One is the liability is actually identified as short-term obligations, or it's considered as another obligations also. Here we are going to understand the current liability first. That is the obligations within the 1 year, or obligations it's actually considered less than 1 year, it's considered a short-term liabilities or a short-term obligations. So it means that any amount of the liabilities which has to be paid within a year, it's considered a short-term liabilities. I'll tell you examples. Suppose if rupees 5,000 goods purchased from XYZ, it is considered the part of creditors. Why? Because if we purchase the goods from XYZ on credit basis, so the 5,000 rupees to be paid to XYZ within a year, this is considered a short-term liability. So the liability is less than 1 year, it's considered as a current liability. It has to be considered an immediate settlement of payments. It's considered maybe 1 month, 2 months, 3 months, 4 months. That's depend upon the policy has been decided between the two parties. Now moving to the another one is non-current liability. The non-current liability is considered, it's a long-term liability. Long-term liability means the liability which is to be paid for more than 1 year. That means it is not obligation is not within 12 months. It has been actually after a 12 months. So any kind of dues to be paid after a 12 months, it's considered as a non-current current liability, or it is considered as a long-term liability. Long-term liability, like if you are running a business and if you have your own capital as well as you need extra money which you are borrowed from the bank or any financial institutions or any other parties, or maybe any kind of a debentures issued or any kind of a bond issued which are to be paid more than 1 year, which is to be refunded or which has been actually payment payback after a 1 year, which has been considered as a long-term liability. So in that sense, the long-term liability is to be paid after a 1 year. It is considered, it's provide a stability for a long-term benefit. Why? Because of the long-term liability amount which is actually carried and used in the business for a longer purpose rather than the shorter purpose. So both liabilities have a different understanding. Short-term liability is generally actually using for the regular business, and long-term liability which has been actually given a stability of the business and which will be used in the business to maybe acquire assets, or maybe which has been actually paid for a certain longer duration. Moving to the next, assets. See, as in the earlier chapter, if you remind me, that I was explaining some financial position and financial statements to be prepared. In that statements, we are preparing a balance sheet. So balance sheet is actually having two sides. One is a liability and other one is it's actually assets. So liabilities is considered as part of long-term liability and short-term liability. Along with that, the capital also. And on the other side, it's an assets. Now, the assets we can consider it's the main pioneer of the business because of it's a backbone of the business. So here, assets is why it's playing an important role, because of the person who brought the capital in the business. The most of the amount of business, it will invested in those assets which is might be utilized to generate more businesses or revenues in the business, or simultaneously which are actually used for the regular transactions. So those assets which are actually carried in the business for a longer period, and purchasing an assets, it's considered a long-term assets, or it's considered as a fixed assets, or it's considered as a tangible assets. Or those assets which are actually used for a regular business considered as a current assets. Let's see how the things are actually there. So there are certain assets which are actually in front of you. The assets means the assets which are actually used for the business to generate a business, for developing a business, is considered as an assets. Like cash, which are actually used for a regular transactions, machinery which are actually used to manufacture a product, furniture which are used actually for the developing and doing a business very smoothly, or a kind of a manpower working, building where the machineries has been installed. These are the assets. Maybe it is for a longer period or maybe a shorter period, but ultimately these are the backbone of the business. Stock, those assets which are actually using for doing a business, like purchasing and selling of goods, so it's considered as a stock. Debtors, when you are selling a goods on a credit basis, the person who is payable to you, it's considered a debtors, right? So these are the assets. Now here for the next term, that is current assets and non-current assets. Current assets, like the assets which are easily converted into a cash within a year, it's considered a current assets. Or maybe the assets which are easily converted into a liquid for a short-term duration, it's considered a current assets. Like a cash, like a bank balance, like debtors, bills receivable, stock. These are the current assets. Non-current asset means the assets which are not converted in a 1 year, or assets which are used for a longer duration, longer period of time, which has been helpful to create a business or developing a business or creating a part of a valuation of a business, is considered a fixed assets. Like land, building, machinery, furniture, trademark, patent, goodwill, etc. So these are the assets. Now I want to give you a more partition. As we discussed the non-current assets, like assets which are actually used for a certain period. So then there are some more bifurcation of tangible assets and intangible assets. Tangible assets means the assets which are easily seen or touched. That's called a tangible assets, like a building, machinery. These are the assets, furniture, vehicles. These are the assets where you can easily seen or touch. These are the tangible assets. Intangible assets means the assets which are not seen or it cannot be easily touched also, consider as a part of intangible assets, like goodwill, patent, copyright, trademark. These are the intangible assets. So tangible and intangible assets are very clear. So these are the tangible, intangible, and fictitious assets. As I already discussed, tangible and intangible assets. Tangible it's considered as a physical existence, and intangible assets does not have any kind of physical existence. Fictitious assets, I just want to tell you there is no physical existence. Even I want to tell you it's an imaginary value. Even there is no any kind of assets realization value, that's considered as a fictitious assets. Even it is a part of an expense which are actually incurred for a long amount or for the long duration, consider as a fictitious assets, and gradually those expenses which are occurred has been write off from the profit and loss account gradually. So that is why it's considered as a fictitious asset. It is not considered as an asset, it's considered as a fictitious assets. Like a preliminary expenses, like an advertisement expenses, or any kind of a debenture discounts or other things which are actually having a larger amount cannot be write off in 1 year. That's why it shows as a fictitious assets. Now moving to the next important terms. There are 4 terms. One by one we are going to take it. First is capital expenditure. Capital expenditure, it is means that the expenditures which are takes place for a long-term assets and which has been used in the business to earn a revenue or to earn a business or a capacity, it is considered as a capital expenditure. So like if you are purchasing a building, if you are purchasing a machinery, land, equipments, vehicles, these are a capital expenditures because of these expenses are actually occur for a longer period, as well as it has been used in the business for long duration. Simultaneously, these all the expenses which are actually utilized in the business to generate a revenue to create a business. Next is revenue expenditure. Revenue expenditure, it means the amount which has been spent for a regular business. So to run a business smoothly, these expenditures are takes place. So expenses like when you are creating a debtors, so when you sold the goods or sell the goods on a credit basis and create a debtors, it's considered a part of this part. Then suppose amount of the expenses which you are taking, suppose the debtors is created. Now, any amount which has not been recovered from the debtors, it's considered a bad debts. Suppose for selling a goods, you are doing an advertisement. So advertisement expense, it's a regular expense. Suppose if you are going to do any kind of a selling expenses, if you are doing any kind of paying a salary, so these are the regular expenses which takes place in the business on a regular intervals or on a regular basis. That is why it's considered a revenue expenditure. Next is debtors and creditors. Debtors and creditors are directly connected with the purchasing of goods and selling of the goods. When you are purchasing the goods from any businessman or any individuals on a credit base, it's considered a creditors because of the person who sell the goods to you, who owe the amount from you, that is considered a part of a creditors. That means the person who sell the goods to you are considered a creditors. In reverse then, that suppose if you are selling a goods to any businessman or any person on a credit basis, it's considered a debtors. The person from where you are receiving the money or a receivable of money, then person who is owed to you, that is considered a debtors. Now here the part of the debtors and creditors are also connected with the bills receivable and bills payable also. But that we will discuss later on. Next is depreciation. Depreciation, it means that any assets, any fixed assets are using gradually lesser than the actual value which was purchased earlier. So that means the gradually the assets utilizations has been reduction as per their capacity. So there has a certain amount of value of utilizations may be deducted from their fixed assets value. So the a reduction of the specific amount of value and reduction of the value due to their physical assets utilizations, it's considered a depreciation because of their useful life has been reduced. Like machinery was purchased 5 years back, were giving us not offer you a same kind of capacity in at present also, because of the after 5 years their capacity utilization or maybe their timing or their other kind of facilities may be reduced due to their usage of life. So the amount which has been deducted or amount which has been reduced from their actual value, it's considered a depreciation. The part is, as I already discussed, that the some amount of creditors and debtors is actually connected with bills receivable and bills payable also. As I mentioned, the debtors where actually you are selling a goods, the person who is owed to you, it's considered a debtors. Now, if the person is actually giving a surety that amount you will pay in some later period of time at specific date, and he is written some written a legal agreements where we are writing a legal agreements and the person is accepting it, the consider as a bills receivable. The same way in case of creditors, if any amount of bills has been written by the creditors and accepted by us, it's considered a bills payable for us. So these are the terminology which has been actually utilized. Moving to the other terminologies also, I'll give you some other terminology like a stock. The stock is actually where any amount of a product or a services which has been used by the business to generate the revenue, it's considered a stock. As precisely, the service is not having any kind of stock, but the goods has having a stock. So the businessman or a company is doing a trading for anything, that's considered a stock. Now there are two kind of stock. One is opening stock and the other is a closing stock. The opening stock means the goods which are actually valued at the beginning of the year, it's considered as an opening stock. And the closing stock, it means the goods which are unsold at the end of the year, it's considered a closing stock. The bad debts. Bad debts, it means where you sell the goods to any person who has not pay immediately, but giving some amount of credit for a certain period of time. After a maturity time or after a certain period of time, the person is unable to pay off that amount, or that amount was not actually received from the debtors, it's considered a bad debts. So the amount which has been actually not received from the debtors considered as a bad debts. Solvent. Solvent means the person who can easily pay all the debts and liabilities from their assets, it's considered a solvent. There is insolvent also. If the person is not having enough amount of assets to pay their liabilities, or they might not have enough amount of assets to pay all the debts, consider insolvent. So these are the basic terminology which is actually helpful to you understand how the accounts is written in the books, and simultaneously which we need to understand the amount of the transactions occurred at the time of the business is going on, we need to bifurcate as per the terminology, because of the certain terminologies is considered as a part of an expenses which has been recorded in such a way, and the certain things which are actually considered maybe assets or liability were recorded in the position statements. So as I discussed with you that this terminology is very much useful and very much required to understand before we start official understanding of accounting transactions to be recorded in the books of accounts. So this is all about I want to explain in the module number 2. I think you might understand all this terminology, and which is to be very much helpful to you to understand in the coming more sessions. Thank you so much.
स्वाध्यायः परः